Now, active bond ETFs. You've got this active bond ETFs. One of the reasons I wanted to have him here, other than get his macro, is he's running a active bond ETF right now, and they're having a bit of a moment. These things. You launched this BlackRock Flexible Income ETF. BINC is the symbol. You started in May. It's got 160 million in assets, and that's pretty respectable. You're the manager of this thing. So I look at this. Two things stick out to me about this. This is a very unusual ETF, folks. Strong emphasis on international. I see Brazilian bonds in here. I see Mexican bonds in here. Generally emphasis on the shorter term. I think your 3-year duration.
Yes,
is that right?
2.3 years.
Okay.
Yep.
Tell me about international. This really leaked out at me. I see almost 40% international. Why international bonds?
Yeah. So I mean, by the way, there's international and international. So when you think about emerging markets, you could be hanging out on the edge in Argentina and Turkey and historically Russia, et cetera. We like Mexico. Think about where short-term interest rates, local rates are in Mexico. You can clip double-digit yield by short-term Mexico as long as you're comfortable with them. We hedge some of the currency. You know, Brazil's a high-quality emerging market issuer, but the size we have in emerging markets relative to where we have international is much bigger in Europe. So things like European investment-grade credit, European high yield, a dollar investor today, because of the currency, can actually swap back. So as a dollar investor, what we do is we swap back things like European investment grade credit to dollars. You get 6.5% for 2-year good quality investment grade companies.
So this is largely it's a dollar play to a certain extent.
Yes. Seems like by the way, we could be here a year from now and we'll be 15% international. Today, it is such a boon to U.S. investors to take advantage of this.
Because of the dollar.
Yeah, by the way, it's the flip side of a European or Japanese investor. You can't buy U.S. assets because the cost to hedge your currency is so expensive. But as a dollar investor, it is a windfall. The beauty of this active ETF is we can move around and take advantage of where the opportunity is. I think, active ETFs in fixed income, people underestimate, there's 68,000 securities in fixed income. And we were talking earlier about the size of the equity market, the number of issuers. There's 68,000 fixed income. I think the stat is 85% of active managers outperform fixed income. One, you get carry and income. Two, you have such diversity of opportunity. What we'll do in this that I think is hard for an individual to replicate, we'll do things like securitized assets, things like asset backs, CLO, but we'll keep it real high quality. Our average rating, I think, is low single A now.
Yeah.
And we're getting.
Well, that's what's unusual about this. First off, 5 3/4 yield on this right now. That's above 2-year treasuries, right? And what's the expense ratio? 40 basis points, I think.
Yeah. Right? We're significantly higher yield than that. But we're actually over 7 in terms of the way we're at 7.4% today. So it's a pretty good yield in the portfolio today.
So I see here, non-U.S. credit, 22%. Those are like international bonds.
Correct.
Mexico, Brazil. U.S. high yield, 17%.
Yeah.
That's pretty high. That's give you a little help there.
There's one thing when you categorize certain, like we buy a lot of high-quality issuers, and we do an awful lot of analysis in terms of the types of issuers we buy. And like I said, like international, things like European investment grade is pretty safe. The nice thing about this, we're getting 90% of the yield of high yield index, and we're half the volatility. Like if you go back since we launched this in May, our volatility is really low. We've outperformed the aggregate index by 500 basis points since we launched.
Is that only because you buy the highest quality junk, or is that?
We buy some high quality. We buy a lot of high quality, high yield. We buy a lot of high quality asset backs. We buy a lot of agency mortgages, and because of like we talked about earlier, the shape of the yield curve, you can buy a lot of yield in the front end of the yield curve today. Keep your yield really high. Keep your volatility down. Now, we don't own. I'm going to say if we don't own anything, but I'm pretty certain we don't own anything longer than a 5-year maturity. Right. So our interest rate volatility, say the ag, since we launched, the ag's down over 4.5%, and we're up since we launched. And the idea is keep your interest rate volatility down, keep your volatility of credit down, and just try and do it over and over again.
And I see asset-backed securities here, 8%. I mean, that could be what? Credit card portfolios? It's anything backed by assets, right? Credit cards, car loans, whatever.
Student loans, auto loans, I say credit cards, residential mortgages. We like parts of the AAA commercial mortgage market. People have said, office property is having a problem. It is. but we like parts of the commercial mortgage
And you have
market.
commercial mortgages in here too, 7%.
Correct.
So how do you put this together? I've asked him several questions about his construction here. Do you use top down, bottoms up? I mean, how does the model, do you look at the global economy and say this, and then you say you have all these tens of thousands of bonds? Is there a bottoms up way to do that too?
So, you know, we run $2.6 trillion in fixed income, so we're pretty active in the market. The way we do it is we set regime identification. So I spend tons of time on the macro and saying, okay, where are we today in the interest rate? Where do I want to be in the short end of the curve, long end of the curve? Do I want to be international? Do I want to be domestic? And then we let our teams do the bottom up. So I'll say to our securitization team, I'm looking to get this yield, I'm looking to get this sort of dispersion, this sort of volatility. I'm willing to take this sort of volatility. Go get me the best assets for it. And then we let our teams do bottoms up. And you know, the intensity of what we do, we have unbelievable risk systems. We run stress testing, scenario analysis. I think we run 350,000 simulations a night to try and look at the stability and make sure, you know, not to get too technical, things like correlations, dispersion, beta is in the right place, and it takes some pretty serious analytics to get it to the right place. But we start with identify the regime we're operating in, where's the best opportunity, then let our teams go find the individual assets.
Yeah, so now let's just talk about how well they're doing on this thing.
Right.
Okay, so you launched in May. So the benchmark is the AGG. And for those who don't know, the AGG is it's sort of a basket of the most diversified stocks and bonds, fixed income that you can have. So you've got high yield, you've got corporates, and here you've got treasuries, right? So this is sort of the benchmark. So there's the AGG on the white line there. You move that again, put that back. We have the AGG on the white line and the BINC there. And you've been outperforming, which is actually it's hard to outperform on fixed income. They can be.
I don't know. I mean,
well, actually, you have a very unusual mix here of stuff.
Because we can build income.
There you go. That's what I'm looking for. Thank you. Last few months, the orange line is the BINC, which is Rick's fund.
By the way, that number, I mean, that's 500 basis points. So they can and the volatility.
And that's only price.
Look at the line.
You're just doing price here too, right?
Yes, sir. And we yield more than I think that's the ag.
Yeah,
but look at how stable the orange line is versus the white line.
Yeah,
and
less
so what
volatility.
we're trying to do is create, you know, really low volatility, very low dispersion, and keep our yield up so you clip in an awful lot of income, and then use our tools to manage the diversification of it.
Yeah. BlackRock also runs iShares. I mean, this is the largest ETF provider in the world right now. But that's mostly passive investments, right? The iShares part. This is actively managed here. So where would this fit in a world that's largely moving towards indexing? I mean, can you make some argument that active management bonds actually has a better proposition for outperforming than actively managed stocks, for example? Is there something about bond investing that makes it more amenable to active investing, or is that not true at all?
So there's two things in fixed income that make it very, very unique. One is the secret about fixed income is if you can build more yield in your portfolio than the index and kick out the stuff you don't want to own. So you can create 50 to 75 basis points a year. Things that trade too rich, things like some of the agency paper, some of the supranational paper, trades too rich, kick it out. Get more yield than the index, and then manage your volatility aggressively. And then the second thing is the point I made earlier. There's 68,000 fixed income securities. Your ability to pick the ones across that make sense for.
So you're saying the plethora of CUSIPs is what they are. They're the individual names is how they number them. CUSIPs. It enhances the possibility for you to win in active management.
Correct. I mean, to think about, we'll look at a piece of commercial mortgage security, and we'll look at all the collateral, and we'll say, okay, is there residential in here? Is there how much office is in there? Is there warehouse in there? And then we analyze it, dissect it. It takes a lot of rigor. It takes a lot of analytics. But you do it over and over again, you know, similar to the way, you know, casino operates. If you can tilt the odds in your favor, just do it over and over and over again.
Well, the increase in choices strikes me as one way you could outperform. It also has the potential for underperforming because you get overwhelmed by the sheer choices.
It does. So I run an opportunistic mutual fund. It's called Strategic Income Opportunities. We've run 1 year, 3 year, 5 years. We've run double the return of the aggregate index at half the volatility. And it's because you have so many tools at your disposal around the world, like you were pointing to. You know, there are times you want to be in Mexico. There are times you want to be out of it. There are times, you know, being tactical in fixed income and having expertise and real teams around the world to do it can be hugely
Not
effective.
easy. How do you compete with the onslaught of these active products I've seen? I've covered so many of these option overlay products that are out there, all sorts of things that I have seen, option income strategies, covered call ETFs, enhanced option ETFs, premium income ETFs. You know what the competition is like, and they've attracted some interest.
Yeah.
How do you compete at that against
So
that?
listen, I mean, I've been doing this for a really long time. We run a lot of fixed income. My view is just try and create durable return, consistent return over time. The reason why I think this BlackRock income will grow significantly. The desire to own ETFs and models, but to also understand how will that ETF do. So if I put in what most financial advisors say, gosh, I want to build a model, I want to understand what that is. The transparency around this today is, gosh, I know I'm getting income, I know I'm not getting a lot of volatility. That will fit an awful lot of models. It's why you've seen it grow as much as it has. It grows so much in the last few months. And our sense is, as more and more platforms put it on, which we've seen recently, that it'll get some real growth. Like I say, because it fits. Like, how do you get, people buy yield because they like high yield, and there are not that many tools to do it. Being able to find a tool that somebody can manage that higher income with some stability, I think will gain a lot of attention.
A lot of people are saying this increase in rates. I want to go back to the macro as we get out of here. The increase in rates has done the Fed's work for it.
Yeah.
Is that your position too?
I think it's a big part of it. I mean, I think part of it's the long end of the interest or the yield curve that's moved up. That tightens financial conditions. That's where most of modern finance issues, corporates issue out the longer end of the curve. Mortgages are issued out 5 to longer on the curve. So the fact that we've moved this much, and we've moved the forwards, not to get too technical, but if you look at the forward rate curves, they've moved back 160, 170 basis points. That is a huge move because people were expecting the Fed to hike and then start easing quickly.
I think a lot of people were baffled why the long end didn't move, but this has historically been a problem. The Fed raises short-term rates and then the long-term doesn't go up enough, and everybody says, why isn't everybody listening to us?
Well,
but now it
is. And it also helps that Treasury's now issuing it a lot, and so you're getting a lot of supply. And to your point earlier, parts of where the traditional buyers aren't there anymore. So we're getting some curvature. I think you'll get more normalization of the yield curve. Part of why I like owning the short end to the belly is I think the yield curve will steepen.